Welcome and good morning, everyone. We're going to give the rest of our attendees a few more minutes to trickle in, but thank you so much for joining us today. It's going to be a good day of retail sales tax, so buckle up and get ready. All right, it looks like we have a pretty good chunk of people in here already. Welcome again, everyone. This is Carl. He works for the Kansas Department of Revenue, obviously, because it's right there in his contact information. If we have any questions during his presentation, he will try his best to answer them. But of course, we do have the chat box, and then we have the Q&A option. And we will answer them as they come in and as best as we can. Carl, if you want to go ahead and get started, you're more than welcome to.
All right. Well, hopefully everybody can hear me. I am Carl York with the Kansas Department of Revenue. Just by attending this, will not flag you for an audit, so don't worry about that. A lot of people get afraid of that, especially when I'm doing this live. I'm going to do my best to give everybody good information. However, whatever I tell you in any format here is not binding to the Department of Revenue, which ought to give you all the confidence in the world on everything I'm going to tell you. It's actually not just me, it's every representative of the Department of Revenue. And basically, it's hard to tell somebody if what they're doing is taxable until we actually audit you a lot of times. The true answer to most sales tax question is it depends, because there's a lot of times there's a lot of variables. There is something that is binding that a lot of people don't realize that is available to them. It's something called a private letter ruling. And it's free. It's something you would write in for. And I say write, you would email, which I guess is writing. And you would be very specific. And they're only going to answer the question you ask. So they're not going to elaborate, and or write a book. So a lot of people get kind of disappointed. Well, they didn't go into any more detail. And said, well, they only answered the question you asked. So you want to put as much detail in this as possible if you write in for one of these. And if it's a vague question, it's going to be pretty much a vague answer. It's going to be based on what you've asked. And if you ask, well, what are all the sales tax due in my industry? They're going to refer you to a publication, and that's it. Because they're not going to provide, we have a publication out there. So, they won't also answer hypotheticals. You can imagine if it's binding. So you would basically send your request for a private letter ruling to the email address there. That's the KDOR _TAC @ks.gov. And in the subject line, you'd put request for private letter ruling, and then attention, policy, and research. And then it takes 30 days or so, and they would give you an answer to your question. And yes, this is taxable, or no, it's not. And that is binding then. Now, I'm just going to give you a quick overview of sales tax. If you have questions, let me know. Some of the questions a lot of people have at the beginning, I'm going to probably cover. I'm going to lay down the foundation with the basics and then add the complications to it. So, I will go over, the basics, and can you buy stuff without sales tax? Yes or no? How, if you can, how do you do that? What rate of tax do you charge if you do? And all these things. So I am going to go over all of that. And will you charge tax in another state or not? So don't freak out, because I will be doing that. So a lot of people get scared that I'm not going to cover that. I am, but I'm going to lay down the foundation first. So sales tax in Kansas started back in 1937. And that's about the time when sales tax in the United States came about. States needed revenue. This was around the time of the Great Depression. They relied upon income tax back then. Of course, the Great Depression, people didn't have jobs. They lost their jobs, sort of like what happened with the pandemic. And less income, less revenue. So they had to figure out a different way to have a revenue stream for the local governments and that type of thing. And they created sales tax. And sales tax, a lot of people don't realize, it's not only on sales, but it's on barter and trade. So, and that's to this day. So if there's barter, you have to come up with a value of that and apply sales tax to that. So a lot of people don't realize that. And that's been around since 1937. What you may not realize is how you paid sales tax back in 1937. You paid with a mill coin. There were a couple states, one or two, that had a punch card system. States like Kansas, Oklahoma, Colorado, Nebraska, Missouri, they had a coin, a mill coin, which was basically a fraction of a cent or whatever. So our system started out at a 2 mill coin, which basically I believe was the sales tax on a dime back then. And we had one coin. It was a 2 mill coin, and you had to have this coin in order to pay sales tax. Well, they didn't give change for the coin. The stores didn't give change for the coin, so they wouldn't give a dollar value for it. So it didn't always end up on a value that would be 2, 4, 6, 8. So sometimes people overpaid tax, and of course they didn't like that. So they had an emergency session, and they created a 1 mill coin in addition to a 2 mill coin. They put a hole in it so you could tell it apart. The whole system lasted around 18 months or so. I think it was like 1939 that they did away with the whole system and created the system we have basically now. Putting on a percentage on the price. We were the first state to do that, in fact. So we were the first state to collect sales tax as it is, and good, bad, or indifferent. I guess we were trendsetters. So a lot of people don't know that. So now you can dazzle your friends with that useless trivia. So sales tax started out in 1937 at 2%. And it was just state sales tax. There were no local sales tax. There were very few exemptions, just the state, federal, and the state had an exemption. There were very few exemptions. So pretty much the sales tax applied to pretty much any sale that was in what they call enumerated. And enumerated means written down in the law. So exemption means that, well, everyone else pays sales tax except us, that type of thing. So there were very few exemptions back then. So 2%. Well, right now the state sales tax rate is 6.5%. Well, then the 70s came along, and the law changed that they said, well, cities and counties would have the ability to impose a sales tax, and a lot of them do. Most of them do. So as a business, you're required to collect not only the state sales tax, but both the city and county sales tax rates. So we call this the combined rate of sales tax. So I'll be saying that a lot. You'll be collecting the combined rate of sales tax. And that's the city and county and state. So the state's always there, and then the city and county. Now, in the city and county, they have the ability to create these special jurisdictions, transportation development districts, community improvement districts, and that's an extra amount in these isolated areas. So you might have seen these all over the place. It's like the community improvement districts, they're all over the place. As you can see, the highest rate in Kansas right now is 11.6, and that's a community improvement district in Ottawa. It's a Holiday Inn Express. Well, at that one location, it's 11.6%. Well, just right next to it, it's not 11.6, but just that isolated area, developed that area, it goes into that development. So these locations are all over. The next highest is 11.5, and you can see Junction City, Leavenworth, Coffeyville, and Chanute, they have that. And usually the trend seems to be like these little strip malls, could be the hotels are popular, Travel Plaza, that type of thing. So I don't know if you guys have seen that, but they're all over the state. So it's not just the bigger cities, but they're all over. I've seen them out in Garden City. I've seen them liberal. They're here in Topeka, so they're all over the place. So it's just that isolated area. It's an extra amount. So if you sell in one of those areas, you would have to collect that rate of tax, which we'll talk about. But right now, our highest rate is 11.6%. So you can dazzle your friends with that. So if you collect that, you would send all of that sales tax to us, and then we distribute it to all the jurisdictions. And our sales tax return has the ability for you to collect and remit the sales tax for the different jurisdictions. So that's how you do that. Some states would make you file a sales tax return for each jurisdiction. Thank goodness we're not like that. It's one return that has the ability to collect for and remit for each jurisdiction. Well, what's taxable? Well, Statute 793603 is the imposition of sales tax. Basically, it says for the privilege, in layman's terms, this is not verbatim, but my words, basically, it talks about the privilege of doing business in Kansas. So basically what it's saying is for the privilege of doing business in Kansas, you must register, collect, and remit sales tax. So it basically is telling you it's not a right to sell, it's a privilege. So when you sell, you must collect sales tax. Well, first thing it goes into is tangible personal property. That's what you need to collect sales tax on. Well, then in the definitions, which is 793602, I got it on the screen there. Tangible personal property is defined as something that can be weighed, seen, weighed, measured, felt, or touched, or any other thing that is perceptible to the senses. So a physical item, basically. But they also can define things as tangible personal property, which they do. So electricity, water, gas, steam, or pre-written computer software is defined as tangible personal property. So that's how they can tax that, because tangible personal property is taxable. So since those things are defined as tangible personal property, they are therefore taxable. So that's the number one thing. So if you sell a physical item, tangible personal property, default is it's taxable. So that's the first thing you need to realize, is the default in Kansas is you sell something, it's taxable. The rule of law, the rule is taxability, the exception is exemption. So just remember that. Auditor, heaven forbid, comes out to audit you, they're already looking at everything's taxable. And in the law, it talks about that the burden of proof that something is not taxable is on the vendor. That'd be you selling. So they're already coming out, everything's taxable. The default is everything's taxable. If you didn't collect tax, you would need some proof that you didn't. So you're going to keep your records to show I collected sales tax on everything I sold, or I have a good reason why I didn't. That's how you keep your records. I really oversimplified that, but that's in a nutshell what you do. Okay, so services. I hear all the time people say, well, it's a service, so it can't be taxable. Well, I know people think that, but there are what they call services that are the imposition of law. They have lots of services that are in the law, written in the law, saying this is a taxable service. So what I want you to recognize is when they define tangible personal property as being taxable, that's a large paintbrush. That covers quite a few things. You know, physical item, there's a lot of physical items. So when you sell a lot of a physical item, that's taxable. They used a large paintbrush as well with services. They said, well, if you repair, service, alter, or maintain a tangible personal property, that is a taxable service. Well, that covers quite a few things. So if you do auto repair, computer repair, clothing alterations, maintain an automobile, you maintain any of these things. Anything you do something to a piece of tangible personal property, that's pretty much going to be a taxable service. But they used a large paintbrush. A couple of years ago, I had classes about once a month in Johnson County, and for a while, about 5 months in a row, I had somebody started an embroidery business. It's a new person every month. I guess it was really booming or something. And the question I would always get with that would someone would say, well, if somebody just brings me a shirt and they want their name on it, that's just a service. That's not taxable. And I'd say, well, let's put it through this filter called the law. So first of all, we'd recognize, well, you recognize the shirt they're bringing you is a piece of tangible personal property because it's a physical item. So let's see if they're doing something here that would be taxable, because the law says if you do one of these things, that's a taxable service. So are you repairing that shirt? No. Are you servicing that shirt? Sort of. Are you altering the shirt? Well, yes, you are. See, it caught right there in that filter of law. So yeah, that's a taxable service. So that's kind of how I kind of think of it there. So that's why it's a taxable service. So when someone says just service, that you can't just think just because it's a service, it's not taxable, because there are taxable services. They consider admissions a service, a taxable service. So admissions to places that provide amusement, entertainment, recreation, consider that a taxable service. And they have a whole definition of admissions that are taxable services. If it entertains and it's a distraction from sort of like reality, I guess. So they consider fitness facilities, admissions to that as entertainment. I guess I consider it torture, but I guess they consider it entertainment. Okay, someone's saying that it's hard to hear me. I don't know how I can fix that. See if I can turn my stuff down here. Hopefully that's better. Okay. I turned it down, so hopefully there's less echo. Got this high dollar set of headphones trying to make it clear for everybody. When I was using the speaker on the computer, I used to have issues with that, people not being able to hear. So if you have trouble, let me know. Okay, so admissions providing amusement, entertainment, recreation. So there are, things that admissions that are not taxable. So for example, admissions to places that are like education, so teaching. Well, there's no imposition in law for teaching to be taxable, so that's not a taxable service. Consulting, that type of thing. But recreation, so if you admissions to carnivals and fairs and even state fairs, plays, movies, even plays that go to like a school play, yeah, they collect sales tax on that. That's right. That type of thing. So if they're selling admission to a place providing amusement, entertainment, or recreation, that is a taxable event. Warranties are taxable if you sell a warranty. Typically, what they're talking about there is if it's included in the price. I mean, you don't ever really think about that. But if you're selling basically an extended warranty, and you can think of several things that maybe nowadays you can buy an extended warranty for just about anything. But a lot of things that one thing that's popular is like a motor vehicle. You sell a warranty. Basically, intangibles, there's no sales tax on in Kansas. So intangible would be like investments and dividends and insurance. But and a warranty feels a lot like insurance. However, in the insurance statutes, it says that warranties are not considered to be insurance. And warranties are part of maintenance contracts, that type of thing. But so when you sell a warranty, you have to collect sales tax on what you sell it for. Now, how this works is, let's say I sell a warranty. I would sell it, but somebody, whatever I sell, somebody brings back something, and I just give them a new one. Well, it's not a taxable event. No money changed hands. But let's say a lot of these warranties have a copay. So example, on these car warranties, a lot of them say, well, you have to pay the first $100 or something like that. Well, anything that comes out of pocket from that customer basically is going to need to have sales tax collected on it. Because it's going to be considered that amount that comes out of pocket has not had sales tax collected on it. Any portion that's covered, it's going to be considered sales tax has been collected on it since they had to pay sales tax when the warranty was purchased. So that's how that works. So that $100 that got to come out of the pocket for that copay, you'll have to collect sales tax on. So the tax base, so what do you collect sales tax on? Well, the law says that the tax base, you collect sales tax on what they call the gross receipts. So the gross receipts basically is defined as the selling price. And that means any consideration. So that's if there's any shipping, handling, delivery, any fees. So if you charge some type of fee, like a COVID-19 fee or a delivery fee, a shipping fee, and anything like that, the sales tax would be on everything, not just the item you sold. So that's what I'm trying to show there in the most basic form there, a shipping of $10. So we didn't charge sales tax on only the $100 item, but also the shipping. It becomes part of the item you sell. So now you have to charge sales tax on the $110 instead of just the $100. So just an FYI, it's called the gross receipts. So if you ever call the Department of Revenue, they'll say that all the time. Well, it's part of gross receipts, part of gross receipts. In fact, sometimes non-taxable items can become part of gross receipts and becomes a taxable item if it's not separately stated on an invoice and that type of thing. Manufacturers rebates, manufacturers coupons really is what we're talking about. Manufacturers coupons, manufacturers rebates, they kind of act the same way. What we're talking about here is a manufacturing company is going to reimburse some store, some business for the amount of a discount. So if you have a customer bring in a coupon and it's a manufacturer's coupon, it's a discount. Well, that big manufacturing company is going to reimburse the store for the amount that's on this coupon or rebate. So the store is still going to get the full amount that they're asking for whatever they're selling. So we're still talking gross receipts here. So example would be if you buy a can of Libby's green beans. Well, if I got a coupon for 50 cents off a can of Libby's green beans, well, if they're $1.50 and I got 50 cents off, well, now I can get the can of Libby's green beans for $1. Okay, me, the customer, I can. Well, since the store asks $1.50 for them, they are still going to get $1.50 for their can of green beans. So they have to collect sales tax on $1.50. Then they apply the 50-cent coupon. Okay, because that manufacturer Libby's is going to send them the amount on the coupon, 50 cents. Now, a store coupon is nothing more than a store says, well, we're going to create our own coupon. It's nothing more than them reducing the price at what they sell it for. They just put it in a coupon format. That's all it is. So in that case, nobody is reimbursing them anything. So their gross receipts on that is, well, if we have our store coupon for Libby's green beans, Libby's not sending us anything. We're just basically going to reduce the price of our Libby's green beans by 50 cents because we got our own coupon. Well, then they would collect sales tax on the final cost. So that would be $1 instead of the $1.50. So a store coupon, basically you're going to collect sales tax on the amount after the coupon instead of before the coupon. Manufacturer's coupon, you would collect sales tax on the amount before the coupon because it's being reimbursed because they're receiving the full amount. So hopefully I didn't confuse you. Hopefully you understand that. And we tried to say before, well, manufacturer's coupon is taxable, meaning, well, the full amount and the store coupon is not taxable. That doesn't sort of make sense. Basically, it's when do you apply the sales tax? You apply the sales tax on the amount you receive, the store receives. Well, they're still receiving the full amount of money on them with a manufacturer's coupon. It's just the part of it is delayed, the part that's on the coupon. Whereas a store coupon, the final cost is what they're going to receive, and it's the reduced amount, and that's what they collect sales tax on. A manufacturer's rebate is very similar. It basically, what we're saying here, a manufacturer's rebate that gets paid to a seller, the store. And the big one on that would be like a motor vehicle, a car dealership. A lot of those get paid to the dealer. And those are optional. A lot of times, well, you can have as a customer, you can have the rebate paid to you, or you can have it paid to the dealer. And a lot of times they do that because it becomes a bargaining tool because they can reduce the price of the vehicle. Okay, so in normal circumstances, it would act just like this in the coupon because they would receive that money, so they would have to, it'd be a taxable amount, But right now, for 3 more years, there's an exception to the law for this, that it will manufacturers rebates paid to a dealer for brand new vehicles that are purchased or leased are exempt from sales tax. So this has been for 3 years, and then they extended it 3 more years. So it's for brand new vehicles purchased or leased in Kansas. So that's just an exception to the law, and that's part of the legislative changes that has happened this last year. So just an FYI. But in normal years, once that expires, unless they make it permanent, but if it expires, then it'll go back to that part being taxable. Well, the law says, well, when you sell something and you give a receipt, an invoice, that you need to, basically gives you 2 ways that you need to invoice your customer. You need to show the sales tax, itemize it out and show what the sales tax is. Or there's another way you can do it. You can put some language on your invoice, all applicable sales tax included, and then you do not have to show any sales tax at all. Now I'm showing your most basic way to do that with, just like I'm showing there, $108 compared to the 100 with the $8.95 sales tax, and then $108.95. But I mean, I could, depending on what kind of business is, I could, list out all the different parts of what I'm selling and just not show any sales tax and still put that so long as I have all applicable sales tax included. Now, what I don't want to do is not show any sales tax and not have language, because then no matter whether I collect it or not, it'll be assumed I didn't. And then if I'm audited, I would owe not only tax, but penalty and interest. So I put the statute there. A lot of people didn't believe me that the statute actually said all applicable sales tax included. So I'm like, well, it does. So it's under statute 793648. And basically that right there, shall bear the statement all applicable sales tax included if the invoice or billing does not reflect the amount of the tax imposed under this act on the sale or contain a statement that all applicable sales tax is included, then shall be presumed that the tax was not collected by the retail. So it kind of gives you the bad news there if you don't put the language on there. So you can dazzle your friends with that information as well. So some businesses, we do recommend the second way to do that, not show the sales tax. In the class I have this afternoon for construction contractors, we absolutely recommend that. But it could be like an online business, because a lot of times the platform you're using only has the ability to collect one rate of tax, which, as you'll find out here, won't work in Kansas, won't work in any state just about that has sales tax. So you'll want to just, do this and then back the sales tax rate out, because one rate won't work. So this way, and what that language really means is if it was taxable, I collected the appropriate amount. If it wasn't, I didn't. So what rate of tax do you charge? Well, Kansas is destination sourcing. And what that means is you would collect that combined state and local sales tax that's in effect where the end user takes delivery. So not necessarily where they pay, it could be, but where they take delivery. Now, Kansas has almost 1,000 jurisdictions. So if I go to Kansas City to Nebraska Furniture Mart and I buy a couch there, if I pick it up there, they're going to collect the rate of tax right there where I pick it up because I'm taking delivery of it there. But if I go there and I buy a couch and they say deliver it to me in Topeka, they're going to have to collect the Topeka rate because that's where I'm taking delivery of it. So that's what destination sourcing is. I would include mileage rate and yeah, you include mileage, everything. Per diem, made me smile on a Sunday fee, made me anything. Yeah, it's all part of the gross receipts. It's all taxable. So now I show publication KS 1700. That's not even really a publication. It's a spreadsheet now. Basically, to find the rate of tax in Kansas, what you're going to want to do is go to the Department of Revenue website. Our website is ksrevenue.org, or if you Googled Kansas Department of Revenue, it should be the top choice. But what I've done here is I've shrunk the Kansas Department of Revenue website. It's blown up to about, I think it's 272%, something like that, for ADA compliance, American Disabilities Act, for visually impaired. So when you go to our website, you only see the top part of that web page. You don't see the bottom part. You have to scroll down. And a lot of people don't do that. So I've shrunk this down to show you there's a whole other part of this web page that you don't even know exists. Well, you might, but a lot of people don't. There's more than one way to get to this tax rate locator. And this tax rate locator is where you can find the rates of sales tax in Kansas. It won't find any other states, but it'll find Kansas. So what I've done is showed you this is how one way to get to it. To me, it's the easiest way, but there's other ways. But this is how I do it. I go down, I just scroll down, I go to the tax rate locator. And there's a law that says if you've used basically our website to determine the sales tax rate, if we were to give you a inaccurate rate, that you're protected by law, that you would be protected by law. So if we gave you, if you collected not enough sales tax based on the information we gave you, you're protected by law. And that's basically your get out of jail free card. And I'll show you, it gives you a number on every time you look up the sales tax. So But you have to do what they call your due diligence. So your due diligence is you have to put in a complete address, and that means as much address as you can. So if you see, there's two choices there. There's calculate the tax by address, and then there's calculate by zip code +4. What the calculate the tax by zip code +4 means, well, they're only going to put the zip code +4. So you don't want to do that. You want to put the calculate tax by address. So with the calculate the tax plus address, you want to put the +4 if it has one. Not all addresses have a +4, by the way. I found that out. So the reason you want to put that +4, because that's going to be the most accurate, because that's going to pin it down to the exact point. And the reason you want that is because, remember, those community improvement districts, the address right next door could be one of those places. So that +4 will give you the exact point. So you don't want to, if you don't have that, sometimes it'll just give you a general area, and you don't want that. So you want the exact area. Then it can give you the best rate and the most accurate rate. So if you don't know where to find the +4, where you would go is United States Post Office. If you can't find it, just go to the Google, but at the website's right there, USPS.com. And they have a zip code lookup page right there. And so you just type in the address, and I put in the Ottawa one there to show you, but it gave us the 9,500 as the +4. And then, so you put it in the lookup page, and this is what it would look like. So it shows you, okay, this is one of those, you see it says the CID, Community Improvement District. So it breaks it down. There's the total rate, 11.6, and then it says, well, the state rate, 6.5, we know that. Franklin County is 1.5. The city of Ottawa is 1.6, and then that special jurisdiction's an extra 2%. So breaks it down for you there. But right here, that request number, it's like a confirmation number. That's what you want to keep, because that's your number that says, hey, I've used your website. So now, if you go to the electronic services, they have the computer people that can, if you're using some type of software to look up rate, they can link up your software so it goes here and captures that request number every time it looks up a rate as well. So they can do that with certain softwares. I don't know which ones and that type of thing. I think most of them, but I'm not a tech person, so I don't have the ability to do that. But you could print this page off or print that number off. Most people print the page off, or capture it in PDF, that type of thing. So a lot of questions I get is, well, I'm going to sell on the internet or what have you, and I have a chance of selling to somebody that's going to be in another state. Do I collect Kansas tax? Do I collect their tax, or what do I do? And I'll say, well, it depends, right? That's the answer. First of all, if you're the person's in another state and they come into Kansas and they take delivery of the item they purchase in Kansas, well, they owe Kansas sales tax simply because they're within our jurisdiction. But let's say they don't. Let's say that you send it to them. You're going to mail it to them through UPS or something like that. Well, now they are taking delivery of it outside of the state of Kansas. They're outside of Kansas jurisdiction. Kansas can only enforce Kansas laws in Kansas. So our laws are no good in that state. So you will not collect Kansas sales tax in that state. So you will report this in your gross sales on your sales tax return. But you need a good reason why you didn't collect sales tax. Your good reason is, well, it was delivered outside of the state. So keep a shipping invoice, that type of thing. A copy of that, and put it in your records. Heaven forbid you're audited. The auditor can say, well, no tax. Why? Oh, shipping invoice. No problem. Then you can move on. Now, do you need to collect that other state's sales tax? What is the answer? I'll bet you know what I'm going to say. It depends, doesn't it? It's going to depend basically on how much you've sold, sometimes how many times you've sold, depending on the state. Depending on if that state has a sales tax. There's still 5 states that do not have a sales tax. believe it's Alaska, Montana, Delaware, Oregon. I forgot the other one, but most states now have some states will call it an economic nexus, basically a threshold. So they'll say, well, if you've sold into our state, whether you have a physical presence or not, because it used to be that you had to have a physical presence before it was required that you collect their tax. But now physical presence is not even required. So this is because of a Supreme Court case, South Dakota versus Wayfarer, or Wayfarer versus South Dakota, however you want to look at it, back in 2018. South Dakota won. And basically what they said is, well, if you sell $100,000 into our state in a calendar year, or you sell 200 times in a calendar year, then from that point forward, and they said more than 200 times, and more than $100,000 or more than 200 times, then you will need to, from that point forward, start collecting their sales tax. And that was their requirement, and that they won the Supreme Court case. So basically, they set the precedence, and so most of the other states have set up something just like that. Now, in South Dakota, they said that's their sales, whether it's a taxable sale or a non-taxable sale. So some states are that way. Some states said, well, only taxable sales. So you got to check each individual state that you sell in. Now, if you're small and not going to be selling very much at all, you probably are not going to have to worry about it. The count usually starts over in January, so calendar year. Then if you haven't sold $100,000, or most of them have $100,000. Some of them did adopt the 200 times, but most did not. There are a couple states that went higher than the $100,000. I believe Texas and New York, I know for sure did. Some of them went 300,000 or 500,000. So you just need to check and see what. So in Kansas, we have we call it remote sellers. So that means someone who doesn't have a physical presence in our state, but are selling into our state. So if they sell more than $100,000, they're required in a calendar year. From that point forward, they'll have to start collecting our sales tax. Good place to find out, if you're selling into another state, what their rules are, what their laws are, would be the Streamlined Sales Tax. And I put the website up there because they have the laws for every state. So you could look there and see, well, would I have to collect their sales tax? Well, they can tell you. They can tell you what their thresholds are. And so every state has different laws, by the way. So you'd think we were all the same, but we're not. Just every state is just a little bit different. Some states are a lot different, let's put it that way. Now, if you're, depending on what state you're selling in, depending on your circumstances, there are, on that Streamlined Sales Tax Act, you might look at what they call certified service providers. They are software companies, basically, and they can collect every state's tax, but specifically Streamlined Sales Tax members. Kansas is a member state, but there are like 23 member states, 22, 23, something like that. But they can collect that tax for you, and the rates and all that. And if you are what they call a volunteer collector, they can do it for free. So you would see if you could qualify for that, and they would provide their service free and their software free and all that. So that's my favorite price, by the way. So you may not qualify for that, but no harm in checking. I mean, the answer's, if you don't check, the answer is no. So you might as well check, because the answer's, it's still no if you don't check. So you might as well check and see. There's about 4 or 5 of them. Don't think that all the companies are the same, because some of them are better at different kinds of businesses. So check each company. Some are better at larger businesses. Some are better at construction businesses. Some are better at tech type things. If you're construction and you're going into a state, you're going to collect that other state's tax because you have a physical presence, because that's still true. But if you're selling without a physical presence, and you're not going to cross their threshold, you wouldn't need to collect that state's sales tax. You just need to keep an invoice to show why you didn't collect sales tax for sales tax purposes in Kansas. So that's just right there. I'm showing you what which states are the streamlined sales tax states. Associate member, Tennessee's an associate member. Okay. And Colorado is a definite no. I find that interesting. California and New York probably would never be a streamlined state. Their economies are, they said if they were countries, they'd be like fourth in the world, I believe it is. So it would not even match most of the states. If you figure Kansas or Wyoming, there's neighborhoods in California that have more people than our whole state. So okay, I'm going to talk about exemptions now. I've talked about, well, the general rule of law is you need to collect sales tax. But now I'm going to talk about, well, depending on who you are, or maybe it is what you're selling, or maybe how it's used, it can be sold or purchased without sales tax. So let me know if you have any questions. I'm not sure if everybody, I should have mentioned this at the beginning. I'm going off of the publication, the KS 1510, the Sales Tax and Compensating Use Tax booklet. And in the lower left-hand corner is where you would see the KS 15 publication, KS 1510. And I'm going to refer to also the KS 1520, which is the Exemption Certificate book, which I don't know if you can see that. And it's going to have most of the exemption certificates we talk about. In fact, I'm going to refer to that booklet now, the KS 1520, on page, I believe it's 14. You'll see a page that looks something like this. So the first thing I'm going to mention is exempt entities. A lot of people will say nonprofit organization, they're nonprofit. Do I tax them? And I'm going to again tell you, well, it depends. First of all, you're going to tax everybody unless they give you an exemption certificate. Because if you're audited, that's one of the things the law says, is that you need to get an exemption certificate. Because you need a signature. It's an affidavit. So if all they do is say, we're a nonprofit, that does you no good. And if all they do is give you a number, that does you no good, because that's not a signature. So that's the first thing you need to learn is, well, I need to get a document from them. Otherwise, heaven forbid, I'm audited. So, because you can't afford to pay the sales tax. The whole idea for sales tax is, well, the end user is supposed to pay it, the final consumer. So it's really supposed to be paid one time by the end user. So you basically are collecting the sales tax and passing along. That's the whole idea. Even though people say, well, I pay the sales tax, truthfully, you're supposed to be collecting it and passing it on. And if you think about that token, that's really a good example of what that was, is, they were supposed to get the tax and then you were just supposed to receive it and pass it on. Okay, what I'm showing you here is a list this is from Statute 793606, which is exemptions to sales tax. This is a list of either specific exempt entities or categories of exempt entities. So to be an exempt entity, you must be listed in Statute 793606 or qualify under one of the categories here. That's true except for the Kansas Bioscience Authority. That's in 7499B12. Other than that, they're all under the 793606. So first of all, the criteria is, well, first of all, must be listed in 793606 or qualify under that. Okay, that's just the first criteria. So not all nonprofits are there. So that's the first thing you need to realize. Just because somebody's a nonprofit does not mean they are automatically exempt from sales tax. There's a lot of nonprofit organizations that have to pay sales tax. That nonprofit status is a federal income tax status. Also state income tax, but not sales tax. So first criteria, they're listed. So the second criteria, they have to apply for and be approved to be an exempt entity. So they still have to apply to be an exempt entity. So just because they're listed doesn't mean they're an exempt entity yet. They have to apply and be approved. That's the second step. So if they're approved, then they have to receive their exempt entity certificate. And it does have an expiration date. So no matter when they became an exempt entity, all of these exempt entities, their expiration is the exact same date, October 1st, 2024. So in 2023, we will, about halfway through the year or so, we will start sending out notifications to all of these exempt entities that they will have to renew. If they don't renew, then they'll have to apply all over again. So, so if you receive an exempt entity certificate from somebody, that's the first thing you're going to want to make sure is that it's not expired. Because if you get one, if you notice they all expired in October 1st, but it was 2020, if you get one of those, it's no good. And they look very similar. So be careful. Now, so if you get one of these, you want to make sure and read the certificate to see what their exemption is good for. Most of the exemptions are going to be good for what they call direct purchases only. So what does that mean? Well, a direct purchase means the money must come directly from that exempt entity. So that city, that county, that church, that school cannot be a reimbursement. So it must come directly from that. Cannot be a reimbursement. Because here's what that means: the money that in statute it'll say that, well, direct purchase only. We put the statute little snippet where it's exempt on the exemption certificate, and we also put what their limitations are and retailer information. So what I just told you, if you looked under the retailer information, there's a sample on page 15 in that exempt entity certificate book, the KS 1520. On retailer information, the first bullet says to qualify for exemption, the certificate must have an expiration date in the future and be signed by an authorized individual. And then it says, the second bullet is what I was just telling you. Payment must be made by the entity on their checking account or on a credit debit card issued to the entity. Acceptance of cash, personal check, or personal credit debit card is not allowed for an exempt purchase. That answers about 95% of the questions I get right there. So I'll get a call every now and then from a church, and they'll say, well, I want to buy this item for our church and donate to our church. I want to do it anonymously. How do I do that without sales tax? I know we're tax exempt. Well, you all know the answer now. They can't, right? Because that's not a direct purchase. So I tell them, well, you can donate money to your church, and then your church could then go buy whatever item it is, and they can buy it directly without sales tax. And boy, I've learned two things from that. The people do get mad, and people go to church will still curse at you. And then I was told I was stealing their blessing. So that's the two things I've learned from that scenario. I've been told 3 times on that. So just putting a little humor in there, sorry. Anyway, so an exempt entity certificate. So if you sell, you need to take one of these because it's an affidavit. If you take one of these in good faith, in other words, you know that this person is with this, you have no reason to believe it's not with the church or whatever, and they sign this, now you are taking this in good faith and you will put this in your records. So now the responsibility for the sales tax now went over to them. So you don't have to collect sales tax. It went over to them. So we have a regulation that talks about the exemption certificates. It's 92-19-25B. It says all retail sales shall be presumed taxable. The burden of proving that a sale is exempt from tax shall be on the vendor, unless the vendor takes an exemption certificate from the purchaser in good faith. And then it goes on to say, well, it doesn't say, well, I said that. It says a vendor shall be deemed to have accepted the exemption certificate in good faith when a vendor maintains the completed certificate as part of its records and has ascertained the identity of the person or entity who presented the certificate and has not shown by the department by the preponderance of evidence to have had knowledge that the presentation of the certificate was improper. So you had no reason to believe for any reason that they were giving you this improperly. You know, if you knew ahead of time, hey, they were not supposed to be doing this, well, then no, that you don't take it, you tax them. But you have no reason to believe. You take this in good faith. Now you don't charge tax, you keep a copy of that. Now you can blanket the certificate, meaning you don't have to take a new certificate every time you sell to them if you have ongoing sales to them, reoccurring sales to them, and this would be more than one sell to them within a 12-month period. So if it's 13 months since the last time you sold to them, you would need to get another certificate. So that's what reoccurring or ongoing selling relationship would be to them. So that's another reason you need to get a certificate. So that is an exempt entity certificate. They are issued an exempt entity certificate. They're one of the very few places that are issued an exempt entity. Everyone else is not. You guys are issued a sales tax number. So you use the sales tax number on certificates. So as a retail business, you collect sales tax like we just mentioned, but like I told you, the whole idea is for the sales tax is to be paid one time by the end user. So you are allowed to buy the stuff you are selling without sales tax. Well, how do you do that? Well, you use a resale exemption certificate in order to buy the stuff you're selling without sales tax. So you use your sales tax number on the certificate. They call it your sales tax registration. So when you register, most of you probably already have a sales tax number, but it's a sales tax registration. You use that number on this certificate. And you just download these off the Department of Revenue website. In fact, in that KS 1520, it's on page 37 or 38. There's a ST28A. That's what this is, the Resale Exemption Certificate. There's one in there. You could literally copy it or something like that and take it to your vendor. And basically, again, it's an affidavit, just like the exempt entity certificate. You're basically saying, hey, what I'm buying, I'm going to resell, and if I don't, I will pay sales tax on it. So, and if you do, let's say you decide you're going to use it, you would owe sales tax on it at your cost. So this is the ST28A. Let's say you are selling something, and I'm going to buy whatever it is you're selling from you, and I'm going to sell it out in Bird City. Well, you would need something in your records why you didn't collect sales tax from me. So I would give you one of these resale exemption certificates. So now you're acting like a wholesaler at that point, right? So now I would just use my sales tax number on here. See, tax registration number. That's where I'd put it. And so you're the seller at that point, and I'm the purchaser. So I would just use this. And you would keep this in your records. And again, you can blanket this if I have an ongoing purchasing relationship with you and you sell to me. Remember, it's the same thing, though. Blanket. can't go more than 12 months between each sell to me. So that's what you would do there. So this is the most popular and most used exemption certificate we have. The next one is probably the next most used, and it's called an ingredient component part. It's ST-28D. Now, it's very similar to the resale exemption certificate, but what this is designed for is for somebody, what they're selling, they have to put it together basically. So they're buying all the parts to this to put it together. So this could be like restaurants. They put this stuff together. So the example I like to give is if I'm going to put these greasy cheeseburgers, I love greasy cheeseburgers, so I'm going to buy all these ingredients for it without sales tax because I sell that greasy cheeseburger. And this is all to go. So I'm going to buy all my hamburger buns and cheese and bacon and ketchup and mustard and lettuce, tomato, whatever goes on this greasy cheeseburger. I can buy all those ingredients without sales tax. But here's the thing, I can buy just a little bit more. If it goes to go, I get that kind of paper stuff that I wrap the burger in. I can buy that without sales tax. If it's a good greasy cheeseburger, I get the paper sack because I want a little bit of the grease to soak through so I can show the world it's a good greasy cheeseburger. I can buy that paper sack without sales tax. I can buy, if I sell the to-go cups and the lids and the straw, if it goes with the product out the door, doesn't come back, not something I reuse, it goes with the product. It's an ingredient component part, and I can buy it without sales tax. If it's something I use over and over again, no, I'm basically the end user of that, and I have to pay tax on that. But if it's something that goes with the product, so if I'm selling products online, well, what am I going to? I'm probably going to buy a box and what do they call those packing peanuts or whatever, or those puffy things or the pop things. If it goes with the product, right? That's ingredient component part. But if it's something I use over and over again, so my greasy cheeseburgers, well, I got to buy my spatulas and my grill and my cleaner. I'm using that. Hopefully that cleaner doesn't go with the product, then something's wrong if that's the case. But so that's, a lot of people don't know that there's some things they can buy without sales tax. You know, if there's a label that goes with that, I can buy that without sales tax. So how do you determine which of the two forms to provide the vendor? Well, sometimes the vendor doesn't know that the ingredient component part is the right one. So if they say, well, give me the resell, you give it to them, but I just want you to know you're allowed to buy those things without sales tax. How do you, the real way to determine though is if you buy it and I buy this and I sell it, I don't have to do anything to it, that's a resell. If I buy this thing and it's used as I'm putting something together, so it's one of these parts to it, so I'm making something, that's an ingredient component part. It's just one of the pieces to it. So like the hamburger, that's the hamburger to it, that's an ingredient component part. That's the bun to it, that's an ingredient component part. That's salt to it, that's an ingredient component part. That's the cheese to it. So that's kind of the difference there. Or if I'm making a car, that's the tire, that's the starter, that's the engine, that's the oil, that's ingredient component parts. But a lot of these vendors don't know that, and they say, give me a resell. You don't care, you're allowed to buy that stuff without sales tax because you give the certificate to them, you don't send it to us. And that's just their good reason why they didn't collect tax. So that's fine, but that's how you would tell that apart. Now, a lot of times if you're buying stuff outside of the state of Kansas, a lot of times they don't recognize and won't accept this ST-28D or the ST-28A, which is the resell. We do have another one, which is the ST-28M, which is a multi-jurisdiction. And a lot of states, most of them will accept this. So this one would be either the seller is outside of the state or the purchaser is outside of the state. So if I'm buying say I have a vendor, I'm buying some stuff outside of the state, and they say, oh, we won't take your resell or your ingredient component part. You can give them this. Okay, they take this one. It's a multi-jurisdiction. So you could use this one because it'll work as either a resell or an ingredient component part, basically. And it'll work fine. So you would give them this one and they'll accept this one. Or let's say you have an out-of-state wholesaler or something buying from you. Just have them fill this out, and that'll work. Because this is your good reason why you didn't charge them tax. I'm buying food ingredients from Sam's. Would Sam's give me an ingredient part tax exempt certificate? Sam's, you would give them an ingredient component part, but here's what Sam's does. They're going to take more information from you. So you'll go to their customer service. You can bring one of these. They probably have this information on their own form. So they're taking our information. They're taking they are taking the ingredient component part or the resell. And they're also taking your information because basically they're going to issue you a card because when you go through the checkout, the person there doesn't know anything about sales tax. They just need to know what button to push, that type of thing. So are you tax exempt? That's all they ask. So, or if you self-checkout or whatever. So yeah, you'll bring that in, and they're going to want a copy. I mean, holy moly. I'm glad you asked that. I'm back in this sales tax, compensating use tax book. I believe it's on page 11. You got a sales tax registration number. Let me see if I can show this to you. Hopefully you can see that. That's when you got it, you got this registration certificate, and you see how they X out all the numbers except the last few. They do that because we have to comply with all the rules for registration numbers from the IRS. Remember, the IRS are the lions and we are just the hyenas. That's the pecking order there. But when you fill out all these certificates, you're going to write your whole number, okay? But you're going to want to make several copies of this. Don't ever give out the original, okay? Because the original on the back side has your whole number and everything on there. But don't give out your original, but make copies of just this side of it. Okay, and bring that to them because they're going to want a copy of that, and they are going to call this an exemption certificate, and it's not. This is designed to hang in your place of business to show the world you are legitimate. You know, you're registered to collect and remit sales tax, and you're a legitimate business. And it's fine that you give them a copy of that because they're going to want that along with the filling out the exemption certificate. So just FYI. But be prepared for them to call it an exemption certificate, and it's not, okay? It is your sales tax registration certificate. But if you go to Sam's Club or, well, I was on the phone with Walmart 45 minutes, and it was like two people speaking two different languages. They kept calling it an exemption certificate, and I didn't know what they were talking about. I said, well, they're issued a sales tax registration, not an exemption certificate. They said I didn't know what I was talking about. They said, you need to talk to the guy that writes the books. And I said, you're talking to the guy that writes the books. So, but finally, it was like the heavens opened up when we finally both knew what we were talking about. And it was a good moment. But so make a copy of this. Places have the right to ask you for a copy of that, and that's fine. Just don't give them your original. Bring them an ingredient component part. Bring a resell too, just in case, because they might want that one or whatever. But they may not want either one because they may have it already on their own, and all they've done is just reproduced what we have and then have their own. No problem. You don't care. They give you just a card to use when you're at Sam's Club. But yeah, you'll be able to do all of that, buy your ingredient component parts without sales tax. And again, someone may at some point buy stuff from you. Let's say if you're selling food, maybe someone wants to buy your stuff and resell it. So they're going to give you a resell exemption certificate, and they're going to mark it up and sell it somewhere. You know, I mean, I don't know. I'm just giving you hypothetical. Do any of you work with farmers? Do sell to farmers, that type of thing? Just wanted to, so I don't want to confuse anybody. Or manufacturing companies. Manufacturing companies use the ingredient component part a lot because that's the stuff that goes into whatever they're manufacturing. That's their ingredient component parts. They use this one a lot. I don't see anyone answering that, so I'm not going to give you more than you need because it'll confuse you. But things that you're the end user of, you owe sales tax on. One question I get a lot are, well, if I donate something I normally sell, do I need to pay tax on that? You know, you bought it without tax. Do I owe tax on it since I donated it? And the answer is, of course, it depends. But in normal circumstances, the answer is yes. In order to donate something, you must own it. And if you own it, you're the end user. Okay, so you owe sales tax at your cost of what you paid for it. And hopefully that's less than what you would sell it for, otherwise you're not really in business. So if, let's say you donated it to some organization that's not an exempt entity, you can do that. You would just owe sales tax on it, again, at what you paid for it, not what you would normally sell it for. Now, if you donate your items to an organization that is an exempt entity, you know, they have that exempt entity certificate issued to them like this, what you're going to want to do is take a copy of that exempt entity certificate, because then you would not owe sales tax on that donation. So I have another regulation to give you. It's 92-1916A that basically says what I just told you. It talks about gifts, premium, prizes, coupons, and rebates. It says each sale of tangible personal property shall be taxable if made to a person who will use the property as a prize, premium, or who will give the property away as a gift. Donors of articles of tangible personal property shall be regarded as the users or consumers of the property. If a retailer donates property that was originally acquired for resale, the retailer shall accrue tax on the cost it paid for the property when the retailer files its next sales tax return. Here's an important word: unless the retailer donates the property to an entity that is exempt from taxation on its purchases under KSA 793606, which is the exempt entities, and amendments thereto, and has provided the retailer with a resale exemption certificate. So they can give you a resale exemption, or gives you a resale exemption certificate. So if they give you a resale exemption certificate, that's fine too. So there you go. Okay, tools of the trade. So if you purchase tools for your business, you're considered the end user of the tools. So depending on what kind of business you have, if you're a restaurant, that'd be all your cooking tools, your utensils, and your stove and oven, and mixers, and toasters, and fryers, and all those things. Your tables, and chairs, and plates, and tablecloths, cloth napkins, and things like that. So when you purchase those, you would have to pay sales tax on it because you use them over again. You're the end user of those things. If you have display cabinets in a store, you're the end user of those things. So now a lot of people get it confused with their federal income tax. They say, well, don't I get a deduction? Not on sales tax. On your federal income tax, you may have some type of deduction, or if it's a large enough item, maybe depreciation or something like that. But for sales tax, no. So just an FYI. Okay, there's the A word. Sorry about that. Audit. Statute of limitations is 3 years, so you need to keep all of your records, all of your invoices, all of your exemption certificates, all of your purchase receipts, and all of your spreadsheets and everything back 3 years. So the year you're in, and then additional 3 years back. Make sure you are showing that you have collected the tax on everything you sold, or you have a good reason why you didn't. Well, I shipped this over to Oklahoma. This was a church. I got their exempt entity certificate. This was a donation. I took an exempt entity certificate for a church. A business bought these from me. I got a resale exemption certificate. That type of thing. Make sure you have those for the last 3 years. They will go over your books. A lot of times they'll send a self-audit. That's a popular way. And what they'll do is they'll send you this information, say, well, they'll go from this date to this date. It'll be 3 years. And they say, give us this information. Basically give you a list, say, this is for your industry. This is what's taxable. This is what's exempt. Go through your books for the last 3 years. You're doing the work. You're welcome to call in for help. You fill that out. You turn it in. If you owe anything, you pay it. They'll basically accept that and not charge you interest and penalty. And since you're doing all the work and you're done, that's your audit. If they come out, they'll come out and audit you. So schedule a time that's convenient. There's never a time that's convenient, of course, but and they'll go through the books with you and work with you. And sometimes they find that you might have overpaid, and so they'll get a refund for you. That's happened as well. Most of those auditors are very nice. One of the reasons they do audit is to educate. Because, again, a lot of businesses have set up out there and never gone through a class like this, have never learned all the rules. So personally, I would rather have them go through this before. I'd hate to learn on the back end, but I'd rather have them learn up front. But if they never had the opportunity, never went, hopefully they can learn and not be harmed too much. So a lot of people think, well, you're just out to get us, and we're not. You got to think of it this way. The state really wants all the businesses to stay in business, because if they're shut down, then no money's coming in. So they really want all the businesses to stay in business, and so they work with them in any way they can. They don't shut businesses down until they give them the last possible chance. They've done everything. So they really don't just go after, try to shut people down. So don't be afraid like that. And that's why I always try to tell people, I'm not turning people in. If I turn people in, no one would ever come to my classes. So that's why I try to tell people that they really just want to help. Sales tax number, just real quick. I don't know if you have one or not, but if you do, nothing magical about it. 004 is just our code for sales tax. Code sounds different, but it's just our number for sales tax. It's if you have an EIN, which is you got it from the Internal Revenue Service. It's your employer identification number, which does not mean you have employees. It's just what they call it. It's going to have that EIN number. Then it's going to have an F and then dash however many locations you have. So usually a 01. So even before you have your sales tax number, you generally know what your sales tax number is going to be. So it's not anything. A lot of people just think that number is something way out there, and it's nothing magical. If you need a sales tax number, best place to get it is a web file. That kind of ran together, but that's supposed to be KS web file, and you go to ksrevenue.org. And this is the web file right here. Go to Customer Service Center and go to the web file. And then register now. I can't help you register. I don't have access to that system. I don't think they'll give me access. I think I locked the system up one time, so they don't give me access to any of that, which, oh, I got a question here. Let's see. Do consumables, gas for torches to produce metal art, for example, qualify under ingredient or component parts? They do not. For some reason, they are particular about welding gas, and I don't know why that is, but they do not. To me, it's consumable, but it's consumed in production. And the only ones that get consumed in production are just very few. Farmers, manufacturers, and some restaurants get like water, that type of thing, part of their water. So, because it's part of the ingredients. But yeah, unfortunately, no. Sorry about that. The question I get a lot is, well, how often do I file my sales tax return? Most people think, well, I got to file at the same time I file my income tax, April 15th. No, it's based on how much sales tax you are collecting in a year. So that's why they say annual tax liability. How much sales tax in a year am I collecting? So when you register, they're trying to put you in one of these brackets. And we're picking it for you. So $400 or less in a year, you're an annual filer. That's the one most people forget the most and get the nasty letter. And you don't want to, even if you don't sell a thing, you still have to file a sales tax return if you have a sales tax number, if you're registered. So that happens a lot. Someone had a number and something happened, they didn't sell anything, and they get well, I didn't sell anything, so I didn't file. Well, if you didn't file, even if you didn't sell anything and you didn't file, this computer, it decides to come up with its own numbers and says, hey, well, we're just going to assume, it comes up with worst case scenario, this is what you sold, and then calculates sales tax on that. And only bad things happen then. So don't let that happen. So annual filers, that means January 25th, which is a weird date. It's hard to remember. Put something to fall on your head to remind you. If you're an annual filer, January 25th, but $400 or less. Now the threshold for sales tax changes by 1 penny. So $400 and a penny to $4,000, you are quarterly. So April, July, October, and January 25th. So if you notice, the 25th is sort of the magic number. So that's your filing frequency. That's what most small businesses fall into. So this is in a year, you're collecting that much sales tax. Monthly, $4,000 and a penny to $40,000. Guess what day of the month? 25th, except for December. And then anything over $40,000, that's what we're going to call prepaid monthly. And they're paying on the first 15 days, they're estimating 90% of the first 15 days, and then paying the amount that's the remaining half of last month. So they're paying that by the 25th. So they're ahead of everybody else. So those are the large businesses you see. You'll see the Walmarts and Home Depots and Lowe's and Menards and all those big businesses, they're prepaid monthly. Okay, this is, like I said, I don't have access to the live system, so I had a test system I had access to at one point. So this doesn't look exactly like it looks like on the live system, but it's very similar when you file your sales tax return. So that's, sorry about that. But this is sort of what it looks like. So let's say you had a withholding account and a sales tax account. It would all, when you register it, it would all pull up and see which one you want to work on. So you can register a bank account on there so that when you pay it, just comes out of your bank account. A lot of people do that nowadays. People used to be afraid of that. Nowadays, that's the preferred way people do it. So I think that's interesting how times have really changed. Now, on our system, you can file your original returns first time you file a return. An amended return means, well, something was wrong or something's got to change on that first return, so I got to fix it. So when you do an amended return, you have to do the whole return over again. So you don't do just the changes, you do the whole return over again because it takes the place of the original return. And then there is something called an additional return. An additional return is, this came about, there were some annual filers that had small sales throughout the year, and they just wanted to post it to their return. But they didn't want to keep amending the return. So what this does is it creates a return, and it does this basically additional return. So it basically just adds a payment to that return is what it does. And that's convenient for the annual filers. So that's where that's come about. So that's what that's about. And you can see that there's an upload. That's for people who have these large amounts and are using some kind of web system. And it has a box there, no sales activity. So if you didn't sell anything during your filing frequency, you just mark that and you're basically done. Okay, so most folks are going to be what we call a multi-jurisdiction sales tax. They'll use that return, the multi-jurisdiction. That's an ST36. The single jurisdiction is an ST16. So the main difference is with an ST36, you're going to look up the jurisdictions you sold in. With an ST16, you won't because it's only one jurisdiction. The ST36, it starts with part 3, goes to part 2, then part 1. So the part 3, the reason it does that is because part 3 is where you have to look up all the jurisdictions you sold in. Well, we got, like I said, almost 1,000 jurisdictions. So you could have sold in 1,000. That would be a mighty big return, believe me. Most people don't. I've seen some where they're like 50, but or more. But most people, it might be a couple or 3 or 4, it could be 10 or something like that. But most people are a multi-jurisdiction. At some point, they're going to do away with the single jurisdiction because this multi-jurisdiction works even if you sold in one. So there's almost no point to having a single jurisdiction. No point in having 2 different kinds anymore. So how this basically works is you'll look up the jurisdictions you sold in, and you'll report your gross sales in each jurisdiction. And so gross sales, what are gross sales? Gross sales are your taxable and non-taxable sales in each jurisdiction. Now, your taxable sales are not going to have the tax in them. That makes sense. So there'll be no tax in these gross sales. So it's your taxable and non-taxable sales. And there's no tax in the taxable sales because what we're doing is calculating how much tax we owe. So we're accounting for everything. So even if all of your sales were non-taxable, they'd still be in your gross sales because we're accounting for them. Merchandise consumed. Okay, what would this be? Well, let's say those donations. Let's say I donated shoes. Or no, let's say I didn't donate them. Let's say I got a new pair of shoes because I'm a shoe salesman, and I got some in and I decided to put them on my feet because I wanted to show them off. Well, I bought them without tax. Well, now I owe tax because I put them on my feet. So I owe tax at my cost. Well, remember, I have to report it on my sales tax return. So that's what I do is I report it right here, merchandise consumed, my cost. So I sell them, I buy them for $50 and I sell them for $100, but I owe tax at my cost. So I put $50 in there. So that's what that would be for, merchandise consumed. And then deductions would be, well, for each jurisdiction, now those non-taxable things, I need to take out of there so I don't pay tax on it. So if you look on that Junction City, so $1,500, if that was all non-taxable, I'd put $1,500 in deductions, so it's not taxed. So I've just accounted for it. But whatever it is, I would just put the amount that's non-taxable in that. So for each jurisdiction, so my taxable amount, and so the gross sales, and then the non-taxable and non-taxable amounts, and then my deductions would go right there in the deductions. So part 2, then it's going to say, well, we don't care what jurisdiction it was in. So to the best of your ability, just describe what these deductions, what these exemptions were. Well, yeah, you're going to see the popular ones. You're going to see deliveries outside of the state. You're going to see sales to another organization, like a nonprofit, like a religious organization, deliveries to for resale, that type of thing, education institutions. But if you don't see one that matches what it was, but you know it was exempt, just put it under other allowable deductions. Here's the thing. People get really focused on this, but I try to tell people, if you're audited, this is not your proof of exemption. Your proof are those records that you're keeping. Remember those documents? That is your proof. So yeah, we're asking this information to the best of your ability. You're going to put this in, but don't freak out if something got put on the wrong line by accident or whatever. The proof is your records that you keep. Okay. So part one, I always tell everybody this is where the rubber hits the road because it starts with tax. Part four, you're not going to worry about that because that's going to be like the electric company and that type of thing, gas company, utility companies. So if you noticed, this was the non-utility deduction. So anyway, so they have a whole nother, they have a part four section. So be thankful you don't have that. Estimated tax, that's for the prepaid monthly folks. I don't know if any of you are prepaid monthly, but so remember I told you they were estimating ahead. So then tax, well, that's how much you owe. You won't have a credit minimum, more than likely. And you're welcome to calculate penalty and interest if you like. It's fairly accurate, but just don't think you have to put anything in there. I had someone who wanted to put something in there every time because they thought that it helped them, and I told them it doesn't help you at all because you don't get it back because now you're saying you owe it. So if you don't know if you owe it or not, don't put it in there because you don't get it back. So total amount due, well, then that's what you're going to pay. So you're going to make sure you pay by the 25th is basically what we're saying here. Personally, I think I'd pay by before 4 p.m. on the 24th. That would be my rule of thumb. Okay, this is a review page. It kind of puts it in the order, kind of like the old paper returns. Make sure you hit the submit return. Once you submit the return, then you get a confirmation number. Make sure you have that confirmation number. Print a copy of this so that you have a copy. I believe that'll have the confirmation number on it. So if something were to happen to this return and there's a glitch, you have that confirmation number. So a lot of times they can reproduce this with that confirmation number. So even if they couldn't, worst case scenario, at least it can be redone without any penalties or interest because we have that confirmation number, and so you're protected. You have access to your previous sales tax returns, so that's nice, but don't rely on that as your only source for your previous returns. Like I said, print a copy and put it in your records because if something were to ever happen to this, then you would not have any more copies of your previous returns. We haven't had any issues with it, but you know, it is a government-run website, which, like, you know, just telling somebody that kind of sometimes gives them a little anxiety. Here's the customer service number. If you have troubles with the filing of the electronic return or need I don't know if they call it a PIN number or access code anymore. It used to be called PIN number. So the first time, and then you create a username and password. It's on the letter that you received as well. Okay, compensating use tax. If you have questions about sales tax, just don't be afraid to ask. And I'm going to be going on compensating use tax. And we'll have more time for more questions as well. So if you remember, when you sold something and it was delivered outside of the state, you didn't collect any Kansas sales tax. And a lot of times that's true for other states, but there's other ways as well that you might owe compensating use tax. What the law says is if you bought something outside of the state and you use it, store it, or consume it inside of the state, and you didn't pay any sales tax on it, or you didn't pay an amount equal to or greater than our combined rate of sales tax, you owe consumers compensating use tax. So if you went to, now this would be something you were the end user of, not your ingredient component parts, not the things you're reselling. So let's say you went to Colorado and bought a computer for your business. You were the end user of that. So when you went into their state and you bought this thing, you are subject to their sales tax. So they're going to collect Colorado sales tax. Well, let's say their sales tax is 7% and our sales tax was 8%. You would owe the difference of 1% consumers compensating use tax. You get credit for the amount that you paid there. Now, if their rate was 9 and ours was 8, would you get a refund? No, because they rightfully collected theirs. And since you paid more than the rate owed in Kansas, you wouldn't owe any. So no jurisdiction will ever refund an overpayment of another jurisdiction's tax. So there's a sales tax return. It's a CT10U. I don't have a slide for that one. It's one of the easiest returns to file. You're basically just putting down the amount that you have paid in another state, the amount owed, and any difference basically owed. This sales tax has been around since 1937, so it's not a new tax. It is very similar to the sales tax. If it's exempt for sales tax, it's going to be exempt for compensating use tax. The sales tax rate and the compensating use tax rate are exactly the same. So in Wichita, the sales tax rate is 7.5, compensating use tax rate 7.5. However, it is a different sales tax. It is a different number. So now, if you remember, for sales tax, it was the gross receipts that you need to collect sales tax on. Well, it's the same, but flipped around. Compensating use tax, you owe the amount of the gross purchase. So even if they charge you shipping, handling, any per diem, anything they might have charged you, you would owe total amount, the gross purchase. If we audit you for sales tax, we will automatically audit you for compensating use tax. And again, statute of limitation 3 years. We've had a lot of businesses that this is the first time they have ever heard of compensating use tax. We were accused of making this tax up. And no, it's been around since 1937. So in most states that have a sales tax, they have a form of use tax. They'll call it use tax. Some call it different things, but it's the same thing. It is a different tax, though. So the consumers compensating use tax are for resellers. That's for out-of-state businesses that do not have a physical location that are selling into our state. They get a retailer's compensating use tax, and they're selling and they're collecting tax in our state. If you're a Kansas business and you're buying something outside of the state and not paying any tax or enough tax, you will register and get a consumer's compensating use tax number. And this is only for things that you are the end user of. If you're not making these types of purchases, you don't need to register for this number. So a lot of businesses have both a sales tax number and a compensating use tax number. So a lot of people think they need to get the retailer's number, but again, that's if you're an out-of-state business. They get that number and they're selling into our state. But if you're a Kansas business, you're a consumer's compensating use tax number. And that, again, that's only for stuff you're the end user of, didn't pay enough sales tax, or didn't pay any sales tax on it when you bought it. Has the same threshold. So whatever this is, it's the same threshold for sales tax. However, it's based on the individual tax itself. So for purchases, $400 or less in compensating use tax in a year would be annual. So you could be annual for compensating use tax and prepaid monthly for sales tax because it's based on the individual tax itself. So it doesn't match up just because you're monthly for sales tax. You're not going to be monthly for compensating use tax. It's based on the individual tax itself. Okay, so just to this confuses people sometimes, so I just want to kind of point this out. Sales tax is the combined rate of tax that's in effect where the end user takes delivery. So I'm in Topeka. The sales tax rate in Topeka is 9.15%. I go down to Wichita. If I go to Menards in Wichita, and the sales tax rate in Wichita is 7.15%. I go down to Wichita, buy a 2x4. I'm there. I pay 7.5%. And I come back to Topeka. I don't owe the difference because I took delivery of it in Wichita. Now, if I go a little further and I go to Oklahoma, if their rate is less than the Topeka rate, now I owe the difference in compensating use tax. So that's the difference if it's outside of the state. Okay, you guys got a lot of information in a short amount of time. What questions do you have? Well, if you can't think of any questions or forgot questions or come up with questions, there's my contact information. I'm happy to answer questions. Right now I'm the only one that does this, so sometimes it takes me a couple days to get back to you, but I will get back to you. So that's my phone number, direct line. That's my email. Wholesalers don't have a number. So wholesaler, now if I'm just a wholesaler, now if I'm a retailer that I'm buying something at wholesale, well, that's just using my sales tax number. But let's say I'm just a wholesaler. I only buy at wholesale and sell to distributors. Well, I don't have a number, and I use the multi-jurisdiction form for that. But if you guys are buying stuff or accepting exemption certificates from people, it could be a resale exemption certificate from another business. They would just use their resale exemption, their sales tax number. Let's see, clarify the reporting items for donations or sold out of state. Well, donations you would owe sales tax on if it was not to one of the exempt entities. So you would report that on merchandise consumed. If you sold it to one of the exempt entities, you would put it on, take their exempt entity certificate or a resale exemption certificate. And then you could just put it on other allowable deductions would be fine. Outside, let me see, these numbers get entered part 3 plus on deduction page. Yes, they do. So both on the deductions for both pages or the merchandise consumed. This afternoon's class is for construction contractors because they have a different set of laws. It's more difficult than this class. What jurisdiction do you use for out-of-state sales? You use your home jurisdiction because there's no sales tax is collected. So I would just use my home jurisdiction, whatever that would be. So if I'm in Wichita, I would just use Wichita as that.
Real quick, It looks like we have a question from Lydia, and I'm not sure if that was answered yet. And they asked, would you happen to know if we were required to pay taxes for donations made to us via crowdfunding?
Taxes via what? I'm sorry.
Crowdfunding, I'm guessing from sites like GoFundMe or Indiegogo or that kind of thing. Is that right, Lydia?
Crowdfunding.
So crowdfunding is when multiple people join and like donate money for a specific cause or project.
What? So is this a membership or is this a what are they donating money for? I mean, is this and what is being sold? Let's put it that way. If this is just a donation to an organization, that's not taxable, at least for sales tax purposes. Typically, not for income tax either.
So maybe I can help clarify. Would the dollar amount received from crowdfunding, because they kind of the platforms can take their own percentage of it, would the money that the individual receives from that crowdfunded project or organization, would that be taxable?
Well, again, I'm not sure what they're selling. That would sound like income.
So Lydia is saying donations would be applied to help start our business. No products are sold.
Yeah, that'd be income tax. So the IRS, they definitely want to know about it, which then trickles down to Kansas income tax. But for sales tax, nothing's sold. So no sales tax. But yeah, for income tax, you'd have to report that. You know, the lions and hyena thing.
That was a good question. That was a left fielder for you, huh?
I've gotten it asked different ways, but yeah. But the thing you got to realize is, you know, I'm teaching sales tax and my mind's stuck on sales tax, but everybody here is not only dealing with sales tax, they'll have income tax, they'll have not only federal income tax, state income tax. If they have employees, then they'll have withholding tax. So this is one slice of the pie, and sometimes the lines get blurry. So I definitely understand. So I don't mind the questions. I'm not a federal income tax specialist at all. I do know some state income tax. So I do the legislative updates on those, at least some. But if there's no more questions, feel free to email me or send me or give me a call. Like I said, I am sometimes takes me a couple days to get back to you because I'm doing this. And I can't answer when I'm doing this, but it doesn't bother me. People always worry about bugging me, and you're definitely not bugging me. USPS address +4. Actually, the USPS.com, I think, is what it is. See, you almost have it right there. All you need is the .com, and you have it. Not with the address, but the USPS.com. And by the way, some places, there are some addresses that do not have the +4. And if that's the case, that's okay. You have done the due diligence. But it is really weird, the jurisdictions. And I don't know if you guys have heard of the Legends up in Kansas City. They're literally all of those businesses, there's places where this business is this rate, this bit right next to each other. They were different rates. So I didn't, someone was asking about the class this afternoon. I'm not sure if they're contractors or not, or they could be practitioners, which that means they do everything. So, when I do live classes, I usually go around the room, ask what everybody does, so I can kind of tailor the class to who I have here. It's hard to do that with this this virtual stuff. So sorry about that. So if you're a practitioner, you're welcome to. I'm sure they're happy to let you come to class. I think you just have to register, but yeah, more the merrier. You just got to put up with me and my ugly mug and yeah, construction contractors. It's complicated. I enjoy it though. I'm not. I mean, I don't like tax. I don't like people think I don't like paying tax any more than you, but I like to know what the laws are. Well, that's all I have. So thank you all for. Oh, you got a question?
Yeah, one more question. We have someone asking, can you please explain what compensating use tax is again?
Compensating use tax. Okay, first criteria is this is something that you are the end user of that you bought outside of Kansas. And when you bought it, you didn't pay any sales tax on it, or the amount you paid in the other state was less than the combined rate of sales tax in Kansas at your home jurisdiction, basically. So then you would owe the consumers compensating use tax. It's the same exact rate as sales tax, but it's a different tax. Let's see, cleaning company. No sales tax on cleaning. The exception to that would be the washing and waxing of automobiles, dry cleaning. Dry cleaning is triple tax, has sales tax, chemical tax, and has an excise tax. Laundry services, exception to that is coin-operated laundry machines is exempt. Let's see. Let's see, we want to go into biohazard. Do you feel next class is beneficial? I don't know what biohazard is, other than I think that's what made the Incredible Hulk, isn't it? With the radiation. I'm not sure if that's it, but is that like what do they call that? Remediation or something? So cleaning is not taxable unless you're installing or applying something. So if you're going to be into real property, so if you're going to be installing or applying anything, then the next class would probably be helpful. Most of what you're going to be doing if you're cleaning is going to be exempt. You just need to pay tax on your cleaning stuff, the soaps and what have you. But yeah, the service would be exempt of cleaning. But if you install something, then that would be taxable. Then there's exceptions to the labor, depending on if residential or original construction, which probably would not happen for cleaning. But so that's we have janitorial companies that'll come to class that'll do commercial buildings and things like that. And most of it's exempt unless they're like waxing floors and things like that. So you're welcome to come to class. I don't want to confuse you too much. Or you might want to take a break for today and then come back. This class is offered just about once a month. Or for this class and the contractor class. So you're welcome to take a break and come back on the day and think about it. But you're welcome to come back anytime, come back twice, come back to this class again. This will mean something more to you once you've been in business too. Because people, when you get out in what I call the real world, people will make you second guess yourself, and they'll sometimes apply other states' laws and say, well, that's not the way it is in Texas or Oklahoma. Well, that's the way it is in Kansas. So always feel free to contact me. And what I tell people is have the person that's giving you a hard time about sales tax, have them contact me. Say, well, I'll let you know. Don't ever take the heat for it. Blame it on that doggone Department of Revenue. Here, I'll let you talk to this Carl guy. He'll tell you. Let him find out. Because maybe it is exempt. Maybe he can tell you. Well, now if it is taxable, we're the bad guys. And we're no more the bad guys than you are. We're just telling you what the laws are. We can't help what the laws are any more than you can. So it's just what we got to do. So feel free to, a lot of times it just has a little more weight when it comes from the Department of Revenue, and then it takes the heat off of you, because we definitely don't want you to lose business over collecting sales tax when it really is not your fault. So now you got a contact right there, direct line and everything. So tell you people you got a tax guy right there at the Department of Revenue. Might impress somebody, I don't know, might depress somebody. So, all right, well, that's all I got. Good luck to everybody. If you have questions, let me know.
Thank you so much. You have a great rest of your day, everyone.
Bye-bye.